Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
Right, well, if you're working in risk, finance, or compliance this last week, it felt like a bit of a roller coaster, didn't it? Just constant contradictions.
An absolute planner's nightmare. We're deep diving this week into, well, profound economic and regulatory dissonance. Everywhere you look, the signals are just clashing.
Yeah, traditional assumptions seem to have gone out the window, so the challenge for banking teams now is modeling for scenarios that are, frankly, polar opposites.
Exactly. How do you plan for, say, recessionary pressures when major business voices are actually calling for tax hikes?
Let's unpack that first one, the fiscal shockwave. Because the Institute of Directors, the IOD, calling for income tax increases, that felt genuinely historic.
It really did. I mean, this is a group that normally champions lower taxes. For them to say this, it suggests they think fiscal credibility is, well, more important than immediate growth right now.
It sounds like a real crisis signal then.
Absolutely. It goes way beyond just politics. The IOD's chief economist, Anna Leach, was quoted in The Telegraph, urging the government to, and this is a direct quote, stop fiddling while the UK burns.
Crikey. Strong words.
Very. She stressed the need for an honest conversation about public finances, basically suggesting we need some short-term pain for longer-term stability.
Okay, but hold on. If the IOD is bracing for pain, does that imply they see trouble ahead anyway? Because right alongside this call for higher taxes, we had some pretty stark recession warnings popping up.
Precisely the contradiction. You had AO World's chief, John Roberts, warning Britain is heading into another recession, that is.
And what was his reasoning?
Soaring business costs, rising taxes, including things like the Workers' Rights Bill. He argued it drives wealth creators out. So you see the clash. One group saying tax more, another saying taxes are part of the recession problem.
So for a retail credit risk team, this is just incredibly difficult. You're being asked to model for essentially two maximum strain scenarios that should theoretically pull in opposite directions. First, a deliberate hit to disposable income through higher income tax. And second, rising defaults because of job losses in a recession.
Yeah, the usual correlations just don't seem to apply. You can't assume it's one or the other. The models need to consider them potentially compounding. Stress testing becomes absolutely crucial here.
So the macro picture is, let's just say complex. But we saw similar dissonance in the regulatory world this week too, didn't we?
We did. A real regulatory paradox playing out. On one side, you've got the PRA making quite a significant move to ease burdens.
Right, the Future Banking Data Program, Phase 1 launch.
Exactly. And this is concrete action delivering on their secondary objective, competitiveness. They're talking about a reporting bonfire.
And what does that mean in practice? But for the banks listening.
It means genuine cost savings. They're looking at deleting 37 reporting templates altogether. That's 34 FEN rep, 2 core rep, and the PRA 109 template.
37? That's quite a few.
It is. And the PRA estimates this could deliver around $26 million in annual savings for UK banks, getting rid of duplication, outdated stuff. So that's clearly good news for compliance departments.
26 million. Okay. But then, in the very same week, the FCA gets hit with this explosive super complaint from Which.
Yes, concerning the home and travel insurance markets, and this is where you get these really serious allegations of systematic failure.
What are Which actually claiming?
They're accusing the FCA, quite directly, of failing its statutory duty to protect consumers. They cite a fundamental lack of FCA enforcement, stretching back over a decade.
A whole decade? That's a strong claim.
It is. They're basically saying problems with how claims are handled, maybe even how products are sold, have just been allowed to fester for too long.
And they backed this up with data, didn't they? The disparity in claims acceptance rates was quite something.
It really was. This should be a major red flag for any chief risk officer. They highlighted that while 99% of motor insurance claims get accepted,
Which sounds about right.
the rate for buildings insurance drops dramatically. Only 63% accepted.
Wow. 99 versus 63, that's a huge gap.
It strongly suggests something's not right, doesn't it? Either with product design, the claims process, maybe the culture around claims.
So what does this mean immediately for banks, particularly those with bank assurance models?
Well, immediate urgency. The FCA now has just 90 days to respond to this super complaint. That puts immense pressure on them, and by extension on all firms, to demonstrate they're meeting consumer duty obligations.
Especially around claims handling and fair outcomes?
Exactly. This isn't just a theoretical risk anymore. The FCA is going to have to be seen to be acting. swiftly.
Okay, so regulatory contradictions. Now let's look at the digital space, because that seems just as divided. Revolutionary potential on one hand, but real exclusion risks on the other.
We're calling it the digital divide contradiction.
Yeah.
And you see it playing out vividly. Take high finance. There's that example of the ex-UBS analyst, Jeremy Lund.
Ah, yes, using ChatGPT prompts.
Simple prompts, like, assume you're a short analyst. And with that, he replicated complex investment workflows that would normally need, well, a very expensive bit of kit.
The famous 20,000 pounds Bloomberg terminal, essentially replaced by free AI. That's quite a democratization of financial analysis.
It changes the game entirely. But then contrast that empowerment with basic accessibility. We heard about the government pushing ahead with plans for a mandatory digital ID.
The Brit Card idea. Initially just for proving right to work, I think.
That's the plan, yes.
Yeah.
But it clearly signals a move towards a national digital identity framework down the line.
And you can see the potential upside for banks there, can't you? Streamlining know your customer KYC processes, compliance, long-term benefits.
Definitely potential benefits.
Yeah.
But, and it's a big but, it comes with this huge consumer duty challenge: digital exclusion.
Right. We saw that anecdote, the 86-year-old woman who literally couldn't visit her local town anymore because she couldn't use the digital parking apps required.
Exactly. So if the state mandates digital ID, how do banks ensure they don't inadvertently cut off access or provide a poorer service to potentially millions of customers who aren't digitally savvy? It's a massive tightrope to walk. Streamlined KYC is good. Creating a new excluded class is not.
Fair point. And while the state is looking at digital identity, it's also flexing its muscles in terms of accessing funds directly, isn't it? HMRC's powers.
Ah, yes, the resumption of HMRC's direct recovery powers. This is a big one for operational compliance and credit risk teams.
What does it mean in practice?
HMRC can now take funds directly from someone's bank account or even an ISA if they owe over £1,000 in tax debt.
Directly seize it.
Yes. The key operational point for banks is ensuring they comply with the rule that the debtor must always be left with a minimum balance of £5,000 after any funds are taken.
And this is part of a wider push on tax debt.
It seems so. They're trying to tackle a massive $42.8 billion tax debt pile that's apparently nearly double what it was before the pandemic.
Blimey, that's enormous.
It is. And remember, looking ahead, from April 2027, banks will also need to start collecting national insurance numbers for savings accounts. That's all about helping HMRC track interest earnings more easily. So, more data collection, more scrutiny.
The net is definitely tightening there. Okay, finally, let's touch on monetary policy and the gilt market. More contradictions from the Bank of England.
You could say that. Governor Andrew Bailey hinted that interest rates might have a further journey down, provided inflation cools off.
An if, a rather large if at the moment.
Well, quite. Because the countersignal is that inflation is proving really stubborn. It's stuck at 3.8%, which the Times noted was a 19-month high. So hinting at cuts while inflation's that high, it creates real ambiguity for anyone trying to forecast lending.
And then there's the bank's actions in the gilt market itself, quantitative tightening or QT.
Yes, QT. That's the process where the bank sells off the assets it bought during quantitative easing to shrink its balance sheet. And they've actually been quite cautious here.
Slowing it down.
They've slowed the pace, yes. They're targeting a $70 billion reduction overall. But they've been shifting sales away from the longer-dated gilts. The idea is to avoid causing too much market turbulence, particularly after past volatility.
But that caution has political angles too, doesn't it? I saw Reform UK wading in.
They did. They argued the UK should do what the Fed and the ECB do, let the Bank of England absorb any losses from these gilt sales on its own balance sheet, instead of sending the bill to the Treasury.
And they put a figure on that.
They claimed it could save the public purse £20 billion. A huge number, obviously politically charged, but it highlights the fiscal implications of these technical monetary operations.
But is there a risk to the bank being too cautious with QT?
Well, that's exactly the warning coming from bank officials themselves. They flagged that being too flexible, slowing QT down too much, could make the market reliant on the bank stepping in all the time.
Creating a dependency.
Precisely. Solving short-term wobbles might actually bake in longer-term instability if the market forgets how to function without that central bank backstop. It's a real dilemma for financial stability.
So when we pull all this together, it's been quite the week. We've had business groups demanding tax rises while CEOs fear recession, regulators cutting $26 million of red tape with one hand.
While the other regulator faces a super complaint over insurance claims where Acceptance rates can drop to 63%.
We've got AI potentially replacing 20K terminals while elderly people can't use parking apps.
And the central bank hinting at rate cuts even with inflation stuck way above target at 3.8%, while carefully managing its exit from the gilt market.
It just feels like every key area, fiscal, regulatory, digital, monetary, is sending completely opposing signals right now.
It forces risk, compliance, finance teams, everyone, to operate outside the usual playbooks. You can't rely on historical correlations. You have to model for these high-impact, fundamentally contradictory scenarios happening potentially at the same time. It's genuinely one of the most challenging environments we've seen in a while.
Okay, so let's leave our listeners with a final thought to chew on. Given those warnings from bank officials that too much flexibility in QT risks making the market permanently reliant on central bank support, how should you, as banking professionals, start adjusting your long-term risk models? Do you need to factor in central bank intervention becoming, well, a permanent, necessary feature of how UK markets actually function?
Something to think about.
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.